What's going on, everyone? My name is Andrew and welcome to Real Estate Basics. Today I'm going to show you how the majority of people are calculating property taxes for their next deal the wrong way. Just head on over to Zillow, and for this example we are in the state of South Carolina and we're looking for a condo to use as an Airbnb. So let's look at this condo that's listed here and then scroll down to Zillow's monthly payment calculator. And for property taxes, you can see they're showing us that the tax rate for this property is 0.52% of the purchase price per year. And if you were to use this value for an Airbnb, that would be wrong. So let's go look up the property tax rate by searching in Google, either by the state or by the county. And you can see here we have the South Carolina Association of Counties, and they split up by year the property tax rates. So let's open that up and scroll down. They have a list of definitions up top, and they get right into how to estimate your property taxes. This is exactly what you want. Now there should be something similar to this for every state and each jurisdiction, but be mindful it probably won't look exactly like this. So step one for this example is to determine the total millage rate, and they give you an equation for that. So this is going to be based on where your property is located and whether or not this is an owner-occupied home or not, because there are nuances that apply in this case, like owner-occupied properties are exempt from school property taxes. So make sure you read the fine print because there's a lot of good information there. Now to determine these different millages to go into this equation, you just scroll down and they have broken up by county the base millage rate, school district millage rate, etc. So you find all those and you add them up to get your total millage. Now step two is to determine the assessed value of the property, which you need two things. The first is the assessment ratio, which is given by the type of property that it is. So in our case, because it's a non-owner occupied property, our assessment ratio is 6%. Now we also need the appraised value of the property. So as an example, the appraised value of the property is $100,000. We're using 6% as the assessment ratio, and we get an assessed value of $6,000. Now the third step is to multiply the assessed value by the total millage rate, which we determine in step one. They give you an equation right here. So we take that $6,000 and multiply it by 0.2, and you can see our property tax for the year is $1,200. Now going back to our example, we're looking up at Zillow. They were assuming an owner-occupied property. So if you look at this example, they show the same property, but it's owner occupied. So the millage rate is a little different and the assessment ratio is definitely different. You can see between the two, a non-owner occupied property is 3 times as much as an owner occupied property. Once you've determined what your property tax rate, you can head on over to my short-term rental, cash flow, and cash on cash calculator within Excel that you can download for free, and we can plug in what our annual tax rate is in terms of a percentage of the purchase price, and that'll help you more accurately calculate what your anticipated cash flow and cash on cash return on investment are going to be. That's it for this one. So if you like this content, please like and subscribe, and until next time, take care.